Okay, so let's set the scene. It's late March 2026. We're 5 weeks into a major geopolitical conflict, and yeah, the markets are flashing red all over the place. But beneath those obvious scary headlines, something else is happening. Something that the usual playbook just can't explain.
On the surface, it looks like a pretty simple story of chaos and fear. But if you look just a little bit closer, there's this second hidden narrative being written in the data. So our job today is to figure out which story is the real one and what it means for, well, the entire global financial system.
First up, let's talk about that obvious story. This is the one you're seeing on every financial news network, every headline. And honestly, it looks exactly like what you'd expect to see during a major conflict.
Yeah, no surprise here, right? A conflict kicks off involving major oil producers and boom, crude oil prices go through the roof. Brent crude is up a staggering 48%. I mean, it peaked over $114 a barrel. It's a classic geopolitical risk premium.
And just as you'd predict, equities are getting absolutely hammered. On one single day, we're talking March 12th, the Dow drops over 700 points. The major indexes, they're on their longest weekly losing streak in almost 4 years. It's a stampede away from risk.
And wow, this chart just perfectly illustrates the fear. The VIX, the market's fear gauge, has more than doubled since its low back in January. Volatility is sky high, uncertainty is everywhere. It is a textbook risk-off environment.
So here's the crucial point. If you stop right here, the story makes perfect sense. Oil's up, stocks are down, fear is up. It all fits the script. But that's exactly the problem, because one very, very important asset completely shatters the pattern.
So let's talk about the asset that isn't playing by the rules, gold. I mean, it's traditionally the ultimate safe haven, but its behavior in March 2026 has been anything but traditional. Just look at this roller coaster. First, the conflict starts, and gold spikes to over $5,400. That's the classic safe haven bid we all know. Then, as the dollar gets stronger, gold sells off hard, dropping over 18%. Still textbook. But then, this happens. A violent snapback, with gold rebounding like crazy towards the end of the month. And this, right here, is the central mystery. That rebound happened while oil was up, bond yields were up, and the US dollar was strong. That just shouldn't happen. In a normal crisis, a strong dollar is like kryptonite for gold. So what gives? Why did the rules suddenly break?
To solve this little mystery, we're going to have to look past the headlines. We need to decode 3 hidden signals the market was sending. These signals, they tell us what was really being priced in.
Okay, signal number 1 is the one we just touched on. That rock-solid, age-old relationship between a strong dollar and weak gold, it completely fell apart. And the reason why is, well, it's profound. Investors weren't just fleeing to the dollar as a safe currency, they were buying gold and the dollar as an alternative to owning dollar-denominated assets, like stocks and bonds. It's a subtle difference, but it is an absolutely crucial one.
All right, signal number 2 comes from the bond market, and it has a pretty scary name, the stagflation trade. This is basically the market betting on a really toxic cocktail of slowing growth and high inflation, all driven by that massive shock in oil prices.
Now let's crack open that rise in bond yields. When you look inside that 45 basis point jump in the 10-year Treasury, you see something fascinating. Most of the move, about 34 basis points, came from rising real yields, which is basically a proxy for growth fears. Only 11 basis points came from what we call inflation expectations. So the market isn't just pricing in inflation, it's pricing in real economic damage right alongside it.
Okay, signal number 3 is the most complex one, but it's also potentially the most dangerous. It's a massively leveraged bet in the Treasury market called the Treasury basis trade. So in simple terms, you have hedge funds borrowing huge sums of money, like 20 to 50 times their own capital, just to profit from tiny little price differences. It's a super high-risk, high-reward strategy that totally depends on cheap, easy short-term funding.
And a trade like this can break in 2 ways. There's the fast path, a big, explosive break from a sudden shock. Or there's the slow path, a quiet, steady bleed. And that's the path we're on right now. As funding costs just creep up, they slowly squeeze the life out of this trade, forcing a gradual unwind. It's way less dramatic, but it's much harder for regulators to stop because there's no single crisis moment. It's just a steady, mounting pressure.
So we've got our three signals: the gold anomaly, the stagflation trade, and the growing pressure in the financial plumbing. Now, let's connect all the dots and see what diagnosis we come up with.
This is how it all fits together, like a chain reaction. You've got a physical supply shock from oil prices. That's layer 1. That creates inflation. This then feeds into layer 2, where rising bond yields reprice every other asset in the entire world. And that in turn feeds into layer 3, putting immense pressure on those funding markets and squeezing those big leveraged trades. You see? Each layer just reinforces the others.
And this brings us to the single most important takeaway of this whole thing. That gold anomaly, it wasn't a fluke. It was a signal that global capital is starting to see the entire US dollar-based asset system, the bedrock of global finance, not as a source of safety, but as a source of risk itself. And that is a profound psychological shift.
So, given this diagnosis of a system under serious stress, the big question is, where do we go from here? Well, the source material lays out 3 potential paths for the whole global financial system.
Okay, scenario 1 is what we'll call controlled de-escalation. Basically, the conflict ends, oil falls, and things kind of go back to normal. Right now, that's seen as a low probability. Scenario 2, which is the most likely, is that we get stuck in this structural stagflation, a long, slow burn that could go on for months. And then there's scenario 3. The tail risk that's getting bigger by the day, that slow funding pressure just keeps building until something in the plumbing finally breaks, triggering a full-blown liquidity crisis.
So as we wrap up, these are the vital signs you need to be monitoring. Don't just watch Brent crude's price. Ask why it moves below $90. Is it because of peace, or is it a collapsing economy? Watch that 30-year Treasury yield. Does it hold above that critical 5% mark? Keep an eye on the repo market spreads. That's the early warning system for stress in those basis trades. And finally, that weird gold-dollar co-movement. Does the anomaly stick around? Each of these isn't just a data point. It's a piece of a much larger unfolding story. A story not just about markets, but about trust in the very foundation of our financial system. The final question isn't just what the markets are trading. It's, are we paying attention to what they're really trying to tell us?